the US dollar is fake money, and in this video I want to explain to you why this is the reason for the rich continuously getting richer and the poor continuously getting poorer. Let's get started. I wrote this post on Twitter about this topic about a year and a half, almost 2 years ago, and I want to go through this in depth. So first thing that I wrote here is that money is an idea that humans came up with to represent value and improve commerce. So what we tried to do was we tried to create value, create things of value, and instead of having to exchange those things directly for the things that we need, we came up with almost a placeholder for value. If we didn't have money, we wouldn't be able to easily price goods and services and would have to resort to barter, direct exchange of goods and services. So let's say, for example, if you wanted to buy a pair of headphones, you'd have to find someone who can accept whatever you can create of value. Maybe you can work for them. Maybe you have apples and you have to trade those apples directly with that person. But if you can't find someone who has headphones, if you want headphones and they want whatever you have, then you're put into a very difficult situation where you can't trade anymore. So what this does is it decreases innovation, it slows down the growth of an economy and the ability for us to actually produce the things that we want and to find people who are willing to give away their time and energy and labor in order to produce the things that we want. Prices are signals. They show us that a good or a service should be worth something in a certain market. So for example, this $100 bill is a signal. If you can buy more of something with this $100 bill, it means that the supply has increased. If you can buy less of it, then that means that the supply has decreased. And both of these numbers are in comparison with the $100 bills. Prices are signals, meaning that they tell you what you should need to give away or receive in exchange for a certain good or service. So let's say, for example, if you're selling it, what should you get back? How many of these $100 bills should you get for a house? The issue with the current financial system is that the dollar can be created out of thin air. So price signals are so important because they give incentives to people, to entrepreneurs to take certain actions. And what this means is that we want people to create the things that we need in our life, and prices give them an incentive to produce these things. So if I can offer you $100 for something that costs you $101 to produce, you're not going to sell it to me. If I can offer you $200 for that thing that costs you $101 to produce, you're probably going to sell it to me. If we can create dollars out of thin air, it messes up that price signal. Supply and demand is purely based on price signal. So if, let's say, there's an opportunity to sell something into the market for $300 when it only costs $5 to make, there's going to be more and more people that fill that need until the price of that item comes down. This is basically just supply and demand. If there's more supply and demand is being fulfilled, the price will come down. So we can see here, for example, if the price of a product goes up, fewer individuals are able to afford it, meaning that demand decreases. And at some point, if there's not enough demand, it won't be worth producing more of. But then there are certain things that you can't go without. So we can't go without food. So the price of food will always increase. We can go without, let's say, Ferraris. Most people don't need a Ferrari. So if there isn't enough demand for Ferraris, of course, the price of a Ferrari is going to come down. Price signals can be corrupted when policy interferes with the form of money being used in society. So if we can create more money out of thin air, it messes up all of the price signals that we should have in order to get entrepreneurs to produce goods and services. If one group can create money at will, they have the power to influence the economy's entire structure. So what this means is if somebody can create $100 bills out of thin air, and they can create more value out of thin air, while the people that they're paying for this, that they're paying to get value from them, they're paying them with these $100 bills, those people are getting screwed over. So let's say merchants, for example, if the US government can create more $100 bills, if any, actually not even just the US government, let's say if anybody can just create fake $100 bills and they can pay people with those $100 bills and they can get something of value out of them, that messes up the entire economy because it gives merchants less of an incentive to produce things because they know that what they're getting paid in is decreasing in value over time. They know that the value that they're getting isn't real. They have to put in their time, energy, and effort to create something of value. But what they're getting in exchange has no value because it can be created out of nothing. For example, this $100 bill, I saw the numbers, it cost about 10 cents to make. If your government can produce $100 bills for 10 cents and it can pay for things that are actually worth $100, 1,000 times more than the cost of production, then of course the supply of dollars will continue to rise forever. It will continue to rise. The price of everything else will continue to rise. It messes up the price signals because the US government can chase goods with money that's not real. The US government is like a banker in Monopoly that can keep replenishing their own bank account. If nobody stops them, there's no way for them to lose. There's no way for them to be kicked out of the game, go bankrupt. They can keep supporting their own finances until everybody else loses. So this is the situation we're in. The US government can keep replenishing its own bank account. The US government can go into as much debt as it wants to, and it can keep winning until every other country eventually loses. Every other individual eventually loses. The only people who win here are the ones that can take advantage of the US government's ability or the US banking system's ability to create money out of thin air. The individuals in charge of money creation may believe that a specific sector is important. They may provide extra support to that sector. For example, we had bailouts for banks. In 2008, we had banks that were supposed to go bankrupt and they were bailed out. What would have happened to the banking system if those banks hadn't been bailed out? How would the banking system be completely different today if we didn't see those bailouts in 2008? How different would prices be today? I think prices would have dropped significantly because more money wouldn't have just been dumped into the economy, and banks and financial institutions would have had to do more due diligence before making decisions. We probably wouldn't have had a collapse like Silicon Valley Bank early in 2023. The way that I see it, an economy needs a working form of money in order to operate efficiently. If there's no working form of money, then the economy can't operate. It won't work the way that we want it to. Money is supposed to be a way to incentivize people to create goods and services so that they know that they can have value for the future. If the value that they're getting loses value over time and it can be diluted, then they have no incentive to produce goods and services. So we can see here, the three purposes that money must serve are unit of account, so measurement of value, medium of exchange, so being able to transfer value to other people, to receive value from other people, and it should promote saving. It should be a store of value. It should be a way for you to save for the future. If you can't save with your money, then what's the point of that money? In North America, a lot of people will tell you, oh, that's not the point of the US dollar. But the rest of the world doesn't agree. There are people in Africa, there are people in South America, people who save in dollars because they don't have a financial system that they can rely on. They can't buy stocks. They can't buy prime real estate. Real estate prices are way too high for them. For example, I have a friend in Nigeria. He can't buy stocks. He can't buy index funds. So he had to rely before Bitcoin was even a thing, he had to rely on saving the US dollar. He was holding on to dollars. He was just holding on to as many as he could because that was the way for them to save. So when the form of money that we use as a society doesn't work as a store of value, it just completely breaks the economy. It makes people think that there's no point of being productive. It increases crime. It gives people less of a reason to work hard, to be productive, to produce something of value and provide it to their fellow human being, to solve problems for other people. Why would you want to spend your time, energy, and resources solving problems for other people when you're not even being paid for it? Why wouldn't you just want to be selfish? That's what this leads to. When a form of money doesn't work for all three of these functions, it breaks society. It just completely destroys. It breaks down everything that we know about how our society should be operated. Okay, so the next one. So the first one is measurement of value. The US dollar does a great job measuring value in the short term because inflation is very low. So let's say 2, 3, 4%, 5%, whatever it is. Prices rise in the short term, but they don't rise a noticeable amount. So if you were to go to Costco one week then you go to the next week, then you go the next week, you probably won't notice a difference. But if you go 1 week and then you go 2 years later, you're going to notice a massive difference in prices. So for example, when I went to Costco in 2020, 2021, a kilogram of chicken thighs would cost $9.99. Today, that same kilogram of chicken thighs costs $14.99. So there's a 50% increase, but we're being told that inflation is 1, 2, 3% a year. So if you save for the long term, if you saved in Canadian dollars over the long term, you would have lost 33% of your purchasing power if it came to chicken thighs. If you wanted chicken thighs, you would have lost 33% of your savings. Over the long term, US dollars are a terrible unit of account. Canadian dollars are even worse. Inflation and interest rates are unpredictable, but determine the future value of the US dollar. So if you expect inflation to be high, you want things that don't have as much risk. You want houses, you want real estate, because you know for a fact that real estate will provide you with the same value over time. It'll maintain the same purchasing power over time. You'll be able to sell your real estate and you'll be able to buy, let's say, a certain amount of food, a certain amount of cars, whatever you want to buy, vacations. Gold works really well for this. It's supposed to work really well for this. So what people do is when they expect inflation to go higher, they hold things that are, I would say, risk-free, risk-off, like gold, because gold is probably the closest thing to being risk-free, at least before Bitcoin existed. Gold was the closest thing to being risk-free and inflation-resistant. Interest rates, when you expect interest rates to go higher, you want to get rid of things that are risk on. So what risk on means is things that are going to increase in price over time because the people who control them can take a risk and add more value. So if interest rates are expected to go up, you probably want to get rid of your tech stocks. If you expect that interest rates are going to rise, you get rid of your tech stocks because tech stocks are highly leveraged. They're borrowing money to create products and services and do research and development, and they have to pay back the interest on the borrowed money that they have with their operations or with other investors, for example. If interest rates are too high, they may not be able to pay back the loan that they have, so they may not be able to pay back the servicing cost on their loan. So what this means is those tech companies could go bankrupt. Inflation and interest rates pretty much go hand in hand. If inflation goes up, the Federal Reserve wants to increase interest rates in order to reduce inflation because it wants to decrease the number of people who are borrowing money. It wants to make it harder to borrow money. So if interest rates are expected to go up, then you want to dump your, let's say, highly leveraged stocks, and you want to buy things that are not as highly leveraged. So let's say companies that are providing consumer staples that no matter what are going to earn a cash flow and are going to be able to earn some kind of revenue in a high inflation rate environment, because people are going to want to buy those things no matter what. We may be able to give up on, let's say, traveling to space, but we can't give up on buying food. So what this does is inflation decreases the value of the US dollar, and high interest rates increase the value of the US dollar. It makes the US dollar more powerful because more people want it. So over time, we have no idea what the value of the US dollar will be. I know those are probably very simplistic examples and explanations, but the point here is that the US dollar is completely unpredictable over the long term. In the short term, it may be predictable, it may be stable, but over the long term, it's not even close. The second function that money is supposed to fulfill is as a transfer of value. So let's go to the number 2. The US dollar works well as a medium of exchange, but only if you have a bank account. So if you don't have a bank account, let's say you only have physical dollars, you have to actually meet with someone to give them their physical dollars. So if you want to pay somebody with this $100 bill, you can't transfer it over the internet. You can deposit it in a bank account, but if you don't have a bank account, then that's not even possible. There's no such thing as e-commerce. For example, e-commerce is extremely difficult if you don't have a bank account, if you don't have a way to transfer value through the financial system. Transferring value to buy things is pretty easy in developed nations. So if you're in Canada, you can probably buy as much as you want. You can have things delivered to you because we have a stable financial system. But in places where there is no stable financial system, if you don't have a bank account, every transaction has to be in person because people are using physical currencies. So the US dollar does okay as a medium of exchange, but only if you have a stable financial system. The third function is as a store of value. Over the long term, US dollars do a terrible job as a store of value. Everyone is forced to maintain the value of their savings in the future. When money can be used as a store of value, the poor don't become poorer, their savings don't lose value over time. So what I mean by this is that at 2% a year, the real inflation rate isn't 2%. It's higher than that because we get better at producing things over time. The real inflation rate's probably 5+%, I would say. And that 5% per year compounds over time. After 30 years, you would have lost something like 80% of the value that you accumulated. So if 5% of the money supply keeps getting added to the economy, you've lost 80% of your purchasing power. If you had to save for retirement, if you had to save for, let's say, what year? 2054, and you didn't understand stocks and you didn't want to buy real estate, you didn't want to take the leverage to buy real estate, you just save dollars. You're losing 80% of your purchasing power of everything that you save today. So if you put $10,000 into your bank account today, expecting that it'll protect you at some point in the future, you'll be able to use it as your retirement fund. You'll have $10,000 in retirement to spend on whatever you want to. In 30 years, you'll still see $10,000 in your bank account, but what you can actually buy with it will massively decrease. I think it's possible that maybe your monthly rent will be $10,000 in 30 years. So today you may be able to spend $1,000, $1,500, $2,000 on rent, but in 30 years, that entire amount that you saved, the entire $10,000 you saved, is going to go to your rent for 1 month. And that's how things would work on a US dollar standard, because US dollars can be created out of thin air. More and more dollars can be added to the economy, but you can't create more rental spaces out of thin air. You have to actually put in the time, the effort, and the energy to produce those rental spaces. So we go back to the main point here. Prices are signals. When prices keep going up because more and more money keeps getting added to the economy, it's a sign of a broken system. We have more houses. We're getting better at building houses over time, but the price of housing keeps going up. And that's not because of immigration. It's not because the population is growing. The population hasn't grown by 1,000 times over the last 50 years. If the money being used in the economy doesn't serve any of these three purposes, price signals become distorted. Other goods and services are used in its place. Since US dollars are a terrible store of value, we see people speculating on what can be used as a store of value. Since US dollars are fake money, we see people hoarding real estate, stocks, and other durable goods to store value since they're harder to produce than US dollars. This has led to an increased demand and price for those goods over time. So what people are doing is they're trying to get rid of their US dollars. Even Americans don't want US dollars. They want US dollars to be the world reserve currency because it means that their government gets to print more dollars, but they don't actually want to hold dollars. If you think about it, how many Americans are short US dollars? How many Americans are in debt and borrowed US dollars because they think that the value of the US dollar will decrease over time? Usually the people who think this are buying houses. They're buying stocks. They're using leverage to buy the things that other people need so that in the future they can sell it to them. If anything, this is a greater fool theory. It's a Ponzi scheme. It's a way to get future generations to pay for your standard of living later on because you know for a fact that they're going to need what you have right now. So what this does is it increases the demand for housing. For example, let's say investors want to keep buying as many houses as they possibly can, and they keep accumulating as many houses as they possibly can. They're competing with families, with individuals who want to buy those houses to live in because housing has actual utility. The US dollar doesn't. So what these people are doing is they're getting rid of their dollars and they're buying as many houses as they can. What this does is it takes away that utility from the people who actually want to use houses as shelter. In the past, we used gold as money. It served all three purposes. Gold was a store of value, a medium of exchange, and a unit of account. You can see here, store of value. 1 ounce of gold has consistently bought a fine men's suit over the last 5,000 years. Back then, it was a toga or whatever people wore as a suit back then, fancy clothes. And I saw this picture on Reddit just to explain the point a little bit better. 10 of these would buy you an average home in 1929. 10 of these will buy you an average home in 2024, which makes a lot of sense because gold can't be created out of thin air. Neither can houses. It takes time, effort, and energy to take gold out of the ground. It takes time, effort, and energy to produce more houses. On the other hand, when you look at the price of housing, House prices have increased by 100 times, 1,000 times in some areas, because the dollar can be created out of thin air while houses can't. One of the great things about gold is that it doesn't have any counterparty risk. And the reason why this is so important is because counterparty risk is the probability that another party in a transaction may not fulfill its part of the deal and may default on contractual obligations. So let's say if you hold these US dollars, the US government can tell you that, oh, $100 bills are worthless now. You can't use $100 bills in commerce. If you want to bring them to us, we can give you $50 worth of value for those $100 bills. But over time, they're not doing this. What they're doing is they're slowly defaulting through inflation. Over time, they've given us these $100 bills. These are a contractual obligation that these things should buy $100 worth of things, but there's no definition of what $100 will be. On the other hand, with gold, if you have an ounce of gold, if you have a kilogram of gold, if you have 10 kilograms of gold, you know exactly what 10 kilograms of gold will be. $100 30 years ago is not the same as $100 today. That $100 bill buys fewer and fewer things over time. On the other hand, gold from 5,000 years ago, the atoms are exactly the same. Gold has no counterparty risk because nobody can change gold. Nobody can default on it. Nobody can make it disappear. If you own physical gold, there's no other party involved. Let's say, for example, if you wanted to pay for food with gold, you wanted to go to a merchant who is willing to accept ounces of gold for groceries, you can pay them in your ounces of gold without involving your government. You don't have to involve a bank. You don't have to worry about whether that gold is real. If you trust one another, and let's say the person who's accepting that gold has a way to test whether the gold is pure within minutes, within seconds. I don't know if that's even possible, but I don't think it is. But if they were able to do that, then there's no other parties involved. You just do the transaction between yourself and the merchant, and nobody else has to take any part of that transaction. There's no other interference. On the other hand, when you have a bank account, you have to rely on your bank giving you permission to transact and then giving the merchant permission to accept money. And either of you can be kicked out of that system. Either of you could have your money stolen because there is counterparty risk with banking. We trust the bank to allow us to transact in the future. And if they don't want us to transact, our ability to transact is gone. Today, nobody uses gold as money. Nobody wants to pay for things in gold because gold isn't portable. The issue with gold is that it's not portable. Moving it to someone across the world could take days, even weeks, even months. And think about the cost of moving that gold across the world. Let's say you wanted to move an ounce of gold to somebody in Japan or in China or in India. How much would that cost you? First, you'd have to have security. You'd have to be willing to take the risk of that gold never making it. There's all these things that create friction when transacting in gold that people don't like. So in order to make trade easier, people trusted in third parties like banks to store their gold and paper currencies to represent their gold deposits. So we used $100 bills that were essentially backed by gold in the past. So they were called gold certificates. You could exchange, let's say, a $20 bill for $20 worth of gold. And at the time, gold's price was stable. These paper currencies could be traded and used as money in the place of gold. So you could give your gold certificate to a merchant and they can give you whatever goods or services that they have. Whoever has those gold certificates can then exchange it for gold if they want to. So let's say, for example, you had a $20 gold certificate. You can go to your bank. You could exchange that $20 gold certificate for gold. If you give that certificate to your merchant, or if somebody steals it from you, then they have that value that the gold certificate's backed by. So they can go to the bank and they can exchange your gold certificate for gold. The US dollar was a form of a receipt for gold deposits from the Federal Reserve, the US central bank. Before 1971, the US dollar was backed by gold, so inflation was stable over time. Any US dollars you held could be exchanged for a specific amount of gold. Eventually, the US government made it illegal for citizens to hold a significant amount of gold. This was in 1933. So they made it illegal for people to hold gold, and they made it so that if you do hold gold, you could go to jail. You could be fined $10,000. And back then, that was a lot of money. This ensured that the majority of gold deposits were kept in the US. The reason why this was the case is because gold certificates were issued in the US. The US kept that gold and it issued as many of those certificates as it wanted to. The US government just held a lot of the gold for the entire world, and it made it so that global trade became a lot easier. In 1971, Richard Nixon announced that the US dollar could no longer be exchanged for gold, so the US dollar went from being a gold certificate essentially to being backed by nothing, to being backed by trust. The US government had printed so many gold IOUs or dollars that it couldn't fulfill its obligation to holders. There were more IOUs than the amount of gold held by the US central bank. So this is where counterparty risk comes in. When you hold dollars, you expect that whoever is creating those dollars, whoever is producing those dollars, won't create too much and debase your savings and basically steal your savings from you. I've shown you this graphic before. We can see here the blue is, let's say you have 5% of the total money supply, it's $5. The total money supply is $100. What happens when suddenly the total money supply doubles, but the amount of money that you have stays the same? This is what's happening in the current financial system. I've had this $100 bill sitting in my drawer here for, let's say, a year. And in that time, it's probably lost 2, 3, 5% of its purchasing power. The cost of all the things that I want has risen. That's because more dollars are being printed. More dollars are being added to the economy. More dollars being added to the economy messes up the price signals that we have. Over time, we can buy fewer and fewer things. If you could buy a basket of groceries for $5 today, when there's $200 in the total money supply, you can only buy half a basket of groceries. You may be able to buy a car with the money that you have today, but when the money supply doubles, you can only buy half. Same thing with houses. If the money supply doubles, you can buy half the things that you wanted because the value of your money has decreased by half. So when we have the issuer of the US dollar printing as many dollars as it possibly can, it decreases the value of everybody else's dollar. It decreases the value that everybody else can exchange their dollars for. This is what makes the US dollar fake money. The US dollar can be created out of thin air. Real money shouldn't be created out of thin air. These IOUs that are being created and added to the economy decrease the value of every single IOU that existed before the new ones were produced and added to the economy. Richard Nixon's announcement turned the US dollar into a fiat currency. A fiat currency is a national currency whose value is derived from a country's promise to back it. In this case, the US dollars are backed by the faith in the US government. But faith isn't value. Faith means nothing. This is just, it's trust. That's all it is. It means nothing. And the US government and the US financial system has proven this over time. The value of the US dollar has decreased so much that the people who saved $1 million, let's say, back in 1930, have next to nothing today. In the last 100 years, the US dollar's value has lost 98%. If you saved $1 100 years ago, today you can buy 2 cents worth of things. 2 cents is nothing. So you'd be able to basically get nothing out of that $1 that you saved for 100 years. The US dollar has been used to steal the wealth of everybody who holds it through inflation. A lot of people will tell you inflation is a good thing. We need inflation. Inflation is the only way that the economy can run. And that's a problem. That's a massive problem. What's happening is with inflation, money is being extracted from people who save in dollars and given to the people who don't save, the people who buy stocks, the people who gamble on real estate. That value is being transferred from everybody else to US investors. When more dollars are created to pay for national expenses, anyone who previously held US dollars or US government debt loses part of their purchasing power. So let's say the Chinese government buys $1 trillion worth of US national debt, and the US dollar has lost 40% of its value. The Chinese government has lost 40% of its savings. And that's a problem. That creates issues between governments, and that could lead to wars. The devaluation of the dollar is leading to the violence that we have today, and it's going to continue leading to more and more violence. We have seen multiple instances of companies that are failing and banks that are taking excessive risk being bailed out. This increases the amount of dollars in the system and leads to the prices of all goods increasing. So when these banks are buying, let's say, mortgage-backed securities in 2007, 2006, 2005, and now these mortgage-backed securities are worthless and the bank is on the brink of collapse and the US government says, we're going to bail you out. What they're doing is they're taking value from taxpayers, they're taking tax income and giving it to these banks so that they don't collapse, just in order to keep the financial system running. And I've seen a lot of crazy thoughts from people who think that Bitcoin is a Ponzi scheme and Bitcoiners want to get rich off the backs of taxpayers. So for example, Sam here said, strategic Bitcoin reserve is just a fancy way of saying I want the government to buy into this Ponzi scheme after I do so I can get rich off the backs of taxpayers. The taxpayers are already paying for everything. The taxpayers are already getting screwed. Bitcoin isn't the reason why the US government is stealing from people. The US government would have stolen from people regardless. So in 2009, Bitcoin was introduced in response to bank bailouts. Satoshi Nakamoto, the anonymous creator of Bitcoin, solved the problem of transferring value from peer-to-peer over the internet without a trusted third party. Before Bitcoin, this never existed. You never had something that could do this. Bitcoin is called digital gold because, like gold, it has no counterparty risk. If you hold your Bitcoin in a personal wallet, nobody can take it without your permission. The number of Bitcoin will max out at 21 million, so it works very well as a long-term store of value. If you save in Bitcoin, you know for a fact that nobody can debase your savings. They can't create more Bitcoin, increase the total money supply, and debase what you have. They can't do that. It's not possible. So what this does is it makes Bitcoin a really great long-term store of value. You can also transfer it to other people if you want. You can move it from your personal wallet to somebody else's wallet, making it a great medium of exchange. You can also value things in Bitcoin. The smallest unit of Bitcoin is called a Satoshi. It's like dollars and cents. One Bitcoin is 100 million Satoshis. So you can value things that are worth less and less and less in Satoshis. And over time, I think the prices of things will stabilize, but I don't think that'll happen until the US dollar goes away as money completely. Bitcoin can be split into 100 million units, like I said, called Satoshis, allowing users to easily spend on a variety of products with different values, like a house or an apple. So if you have Bitcoin, you can spend it on an apple. You can use the Lightning Network to pay for an apple, or you can buy a house with it if you want to. You have a regular Bitcoin wallet and somebody wants to take your Bitcoin in exchange for their house, you can pay them with Bitcoin. Bitcoin is still new. The price in US dollars is volatile. At this time, I thought that Bitcoin was volatile. I didn't realize that the US dollar was volatile. This volatility means that it's not yet the best unit of account or medium of exchange. Prices change so much because the world is still deciding Bitcoin's true value. And this will take a long time. I think this could take 10, 20, 30 years. And in that time, Bitcoin's price in terms of US dollars is going to go to infinity. Because why would somebody want something that can be created out of thin air in exchange for the best form of money in the world, the best store of value in the world? The US dollar can be created out of thin air. Why would merchants want US dollars if they have an alternative with Bitcoin? If somebody is creating oil, for example, let's say an oil producing country, why would they want pieces of paper for their oil when they know that the alternative is something that can't be created out of thin air? Of course, some oil producing countries will continue to want US dollars, but over time, those oil producing countries are going to get screwed over because the value of their savings will continue to decrease. Even though they're producing oil and it costs them time, energy, and effort to produce it, they're getting paid in something that can be created out of thin air and has no requirement for an input of time, energy, and effort. So they're getting screwed over. The savings that they have is going to constantly be debased until it's worthless. For something to become a reliable medium of exchange or unit of account, it needs to prove itself as a store of value over time. In the last 14 years, Bitcoin has been used by an increasing number of individuals and institutions as a store of value. At this time, there was no talk of a strategic Bitcoin reserve for the US government. There was no talk of massive countries accumulating Bitcoin. At this time, there wasn't even a Bitcoin ETF. March 27th, 2023, the ETF announcements, the ETF plans, from what I remember, came out around August or September of last year. That was before this post was published. I published this post before BlackRock started selling Bitcoin to its customers. And think about where Bitcoin has gone since then. We can see here when this post was put up, Bitcoin's price was around $27,000 or $28,000. In that time, it's more than tripled. It's almost gone up 4 times. At one point, Bitcoin was at $108,000. So over time, the number of people who are using Bitcoin as a store of value is increasing. It's increasing, and you can see that from the price. If more people want Bitcoin, it's a price signal that there's not enough supply, but there's a lot more demand. So if more people want Bitcoin, the demand is going up, but the supply is fixed. If the price of Bitcoin is going up, it means that the number of people who want to use Bitcoin as a store of value is rising, or the people who already own Bitcoin want more of it. They want to own more of it, and they're not willing to sell it. This could be completely changed. Let's say some whale dumps 1 million Bitcoin, the price could drop significantly. I don't think it'll drop for a very long time. It'll probably be bought up very quickly. But over time, all that does is it increases the number of people who have exposure to Bitcoin as a store of value. And that number will continue to rise until Bitcoin is the world reserve asset, until Bitcoin is being widely used as money by every single individual in the world. As Bitcoin adoption increases, the exchange rate in US dollars will probably become a lot more stable. I don't agree with this. I used to think that Bitcoin is volatile and not the US dollar. The reality is that the US dollar is volatile. I think that the exchange rate in US dollars will probably become more volatile once Bitcoin adoption increases because the US dollar is a piece of paper. People don't want US dollars. The US dollar's price in terms of, let's say, Argentinian pesos is extremely volatile. But that doesn't mean that the US dollar is volatile. It means that the Argentinian peso is volatile. Exchange rates for Bitcoin must become more stable for it to be used more widely to facilitate trade. Again, I don't quite agree with this anymore. I think that Bitcoin is stable. One Bitcoin is always going to be equivalent to one Bitcoin. Nobody can change that. It could take a long time for this to happen, for people to actually realize that one Bitcoin equals one Bitcoin. But at that point, I don't think we're going to be pricing Bitcoin in dollars. Bitcoin is not just another asset. At this time, I did think that. I thought Bitcoin is just another asset. It's part of the economy. It's part of a well-diversified portfolio, but I don't agree with that anymore. I don't agree with that at all. The way that I see it, the world is going one of two ways. Either Bitcoin goes to zero, or more and more people want Bitcoin and they want to adopt it as money and they want to use it as their primary savings vehicle. More countries want to adopt Bitcoin. More institutions, more companies want to adopt Bitcoin as their treasury asset. And Bitcoin's prices continues to rise and it goes to 1 million, then it goes to 10 million, then it goes to 100 million because there won't be any Bitcoin available to be bought at some point. People won't want US dollars for their Bitcoin when merchants start accepting Bitcoin in exchange for goods and services. That's where the world is going. That's where I think the world is going, at least. So if you figure this out earlier than the rest, if you figure it out earlier than, let's say, the billionaires of the world, those billionaires are going to be willing to pay you tens of millions of dollars for one Bitcoin. So if you have a fraction of a Bitcoin, let's say you have 0.01 Bitcoin, eventually it's going to be worth $100,000. It's going to be worth $1 million at some point. Over time, the price of Bitcoin in terms of US dollars can only go up because the value of the US dollar can only go down.